Have you ever wondered about Bitcoin ETFs and their impact on the cryptocurrency market? Well, you're not alone. Bitcoin ETFs, or exchange-traded funds, have been a hot topic in the crypto world lately. This is largely due to the recent approval by the Securities and Exchange Commission, or SEC, which opens up a whole new avenue for investors to engage with Bitcoin. Essentially, a Bitcoin ETF is a financial product that tracks the price of Bitcoin and is traded on traditional market exchanges, just like any other ETF. It allows investors to gain exposure to Bitcoin without actually having to buy or store the cryptocurrency themselves. This development is expected to increase both the demand and price of Bitcoin, potentially driving its legitimacy and adoption to new heights. But as with any investment, Bitcoin ETFs come with their own set of risks and challenges, which could include fees, volatility, and regulatory scrutiny. So what exactly are these Bitcoin ETFs and how do they work? Let's dive into it. A Bitcoin ETF is a fund that tracks the price of Bitcoin. But let's delve a bit deeper. Essentially, a Bitcoin exchange-traded fund, or ETF, is a type of investment fund and exchange-traded product traded on traditional stock exchanges. Unlike purchasing Bitcoin directly and dealing with digital wallets and cryptographic keys, investing in a Bitcoin ETF allows one to get involved in the Bitcoin space without needing to buy or store the cryptocurrency. It's a way for you to have a stake in Bitcoin's performance without having to own it outright. So how does it work? Well, a Bitcoin ETF mirrors the price of Bitcoin. It does this by either tracking the actual coins themselves or via futures contracts, which are agreements to buy or sell Bitcoin at a future date and at a specific price. This way, the ETF's value is intrinsically linked to the price of Bitcoin. In essence, if Bitcoin's price goes up, the value of the Bitcoin ETF rises correspondingly. And of course, if Bitcoin's price drops, the same happens to the value of the ETF. This is how you, as an investor, can gain exposure to the price movement of Bitcoin without the need to actually hold the cryptocurrency. The beauty of Bitcoin ETFs is their accessibility. They can be bought and sold on traditional stock exchanges. This means you can invest in the Bitcoin market just like you would with other industries such as tech or healthcare, right from your usual investment account. Bitcoin ETFs serve as a bridge between traditional finance and the emerging world of cryptocurrencies. They offer a way for more people to get involved in the cryptocurrency space without the need to navigate the technical complexities of buying, storing, and securing Bitcoin directly. The SEC's approval of Bitcoin ETFs is a major development for the cryptocurrency market. This significant event has opened up a new era, allowing investors to gain exposure to Bitcoin without the need to buy or store it directly. The question that now stands is, how will this impact the crypto market? One of the most immediate effects we're likely to see is an increase in the demand and price of Bitcoin. Why? Because Bitcoin ETFs make it easier for institutional investors to enter the crypto space. These are the huge financial players who manage billions of dollars in assets. By providing a regulated and familiar avenue for these players to invest in Bitcoin, we're likely to see a significant inflow of funds into the market. And as we all know, when demand increases and supply remains constant, prices tend to rise. But it's not just about the money. The approval of Bitcoin ETFs also lends a level of legitimacy to Bitcoin that it previously lacked in some circles. As Bitcoin becomes a part of more conventional investment portfolios, it's likely to be viewed less as a speculative asset and more as a legitimate investment. This could lead to wider adoption of Bitcoin, both as an investment and as a medium of exchange. However, it's not all roses. While the approval of Bitcoin ETFs could lead to a rise in the price of Bitcoin, it's important to remember that it could also increase its price volatility. The introduction of Bitcoin ETFs brings new sources of supply and demand shocks, arbitrage opportunities, and market sentiment into the equation. As more investors and institutions enter the market, the price of Bitcoin could become more susceptible to sudden swings. The approval of Bitcoin ETFs is a significant step forward for the cryptocurrency market, potentially leading to increased demand, higher prices, and wider adoption of Bitcoin. But as with any investment, it comes with its own set of risks. As always, it's crucial to do your own research and understand the potential impacts before diving in. One of the key challenges associated with Bitcoin ETFs is the fees. As with any ETF, there are management fees that investors must pay. These fees are deducted from the returns earned by the ETF, which means that the higher the fee, the lower the net return for the investor. Because of the unique nature of Bitcoin, there may be additional costs associated with securing and storing cryptocurrency, which could further eat into the returns. Another risk is the volatility of Bitcoin itself. Bitcoin has been known for its dramatic price swings. And while this can lead to high returns, it can also result in significant losses. Now, with the introduction of Bitcoin ETFs, this volatility could potentially be amplified. As more investors gain access to Bitcoin through ETFs, the potential for supply and demand shocks, arbitrage opportunities, and shifts in market sentiment could lead to even greater price fluctuation. Regulation is another challenge. While the SEC's approval of Bitcoin ETFs is a major step forward, the regulatory landscape for cryptocurrencies is still evolving. Changes in regulations can have a significant impact on the value of Bitcoin and, by extension, Bitcoin ETFs. Investors need to be prepared for the possibility of regulatory changes that could affect their investments. With the approval of Bitcoin ETFs, it's likely that we'll see more and more cryptocurrency ETFs entering the market. This increased competition could potentially dilute the demand for any single Bitcoin ETF, which could impact its performance. So while Bitcoin ETFs could bring many benefits, they also come with their own set of risks that investors must be aware of. The SEC's approval of Bitcoin ETFs is likely to have both positive and negative effects on the price of Bitcoin. This major development for the cryptocurrency market enables investors to gain exposure to Bitcoin without the need to buy or store it directly. It's a game changer, potentially paving the way for increased demand, price, legitimacy, and adoption of Bitcoin. However, the road ahead isn't without its bumps. Challenges associated with Bitcoin ETFs such as fees, volatility, regulation, and competition must be taken into consideration. The approval of Bitcoin ETFs could also lead to increased price volatility due to new sources of supply and demand shocks, arbitrage opportunities, and shifts in market sentiment. Reports suggest that the price of Bitcoin has already seen significant growth in anticipation of the SEC's approval and could continue to rise as more investors and institutions enter the market. But remember, the price impact of Bitcoin ETFs may not be as straightforward or predictable as some might think. The potential benefits and risks of Bitcoin ETFs are varied, and the impact on Bitcoin's price will depend on a multitude of factors and scenarios. This makes it all the more important for you, as an investor, to be aware of these potential outcomes. So, before you decide to dive headfirst into the world of Bitcoin ETFs, do your homework. Arm yourself with knowledge. Analyze the market, evaluate the potential risks, and consider your own financial goals and risk tolerance. Make informed decisions when investing in the cryptocurrency market. Thank you for watching, and stay tuned for more informative videos